Ooh, ooh. All right, guys, I'm back. Let's do this. Let's do this. Have a meme stock over here. Up from here. Oh, I want to show you this one. Of course, there's news. I want to show you that one. Poised for the lowest close since August 2022. Wall Street Journal. Losing streak en route to reach 7 trading day as shares of Gamestop post their lowest to the closes. Hold on one second. My dog is going crazy the minute I go live, you guys. So just bear with me a minute. Okay, 1 second here. Let me put something on for you to hold on 1 second. Alright guys, I'm gonna step out a minute because my dog is going crazy. I'll be right back. Okay, so I'm gonna put this news on so that you could hear the news, see and be. See? Now I watched them because they are negative on GameStop, obviously, but there was. Let's listen to this one right here. Powell speaking today. And it's about 4 minutes long, so go ahead.
Now, I just want to go with Steve's reference. By the way, the investment committee here at Post 9, Joe Terranova, Jenny Harrington, and Jim Lebenthal. Exciting day. The market's really popping. Just to go with what Steve was just talking about, the Clint Eastwood reference, looks like he made the markets day. We're seeing the S&P pop, the NASDAQ pop, all of them up just about 1/3%. The S&P easing back just a bit. What did you make of these prepared remarks? Steve saying it's pretty neutral. A lot of different messages in those prepared remarks. Of course, we're still waiting for the Q&A coming up.
A lot of different messages. And as Steve was speaking, all I was doing was focusing on a U.S. 10-year Treasury. Right. Would the U.S. 10-year Treasury go above 5% as Steve was talking, addressing the comments from the Federal Reserve Chairman? That's not what's happened. No. We have a 10-year down at 491 right now as we speak. I think the market, in the way that it is positioned, needed a very hawkish statement to get above 5%, because in the totality of where speculation is for the Treasury market right now, it is overwhelmingly short Treasury. So you needed to push it higher above 5%, a very hawkish statement. Sure. You didn't get that. You're sitting at 491. In the coming days, could we get something to push above 5%? Absolutely. I'm not dismissing. But where we are in this moment right now, it wasn't hawkish enough to push us above 5%, and equities are responding accordingly.
Yeah, just to your point, as you mentioned, the 10-year at 4.91 earlier today. I believe it was up to about 497 or so, at least when I was doing my show, Worldwide Exchange, easing back quite a bit. Jenny, over to you. What did you make of the prepared remarks? And again, I want to emphasize to the audience, we're going to go to the Q&A after the speech. Right now, we're breaking down these prepared remarks.
So what really caught my attention, well, first of all, the Clint Eastwood thing, when I opened, I thought, yeah, we all are. Right? We all are, all the time. As investors right now, there's so much to be nervous about. We're all sleeping with one eye open, whether it's broader macro geopolitics, whether it's, interest rates, earnings that are starting to come out. So there's a real unease. But the whole neutralness to that statement, I kind of think that's where we are. And it doubles down on me, for me, where I stand, which is, look, dovish is no good, because what does dovish mean? Dovish means that we have a weaker economy and that's going to be harder for earnings to grow off of. Hawkish is no good, because that means higher rates for longer, which caps valuations. That's no good. So all of this just kind of sets me more in my tracks on we're pretty stuck for right now, right? We really need something to give. That's maybe not even the right way to say it. We really need something to evolve, right, where we can see earnings start to grow significantly or valuations start to expand significantly. And I think the only thing that's going to get us there is the passage of time. And it's going to be a long time to get there. It's not a quick overnight fix. I mean, if you think back to 2 years ago, Frank, I was looking back at this market letter that I wrote to clients, and 2 years ago I said, hey, we've just grown at 16.5% on an annualized basis for the previous 10 years. The past 2 years, the market's perfectly flat. Why is that? Because we're digesting that outsized growth. That's going to take a long time to work off of, and we're in that process.
Yeah, so important to know also the market's easing back from that initial pop after the remarks were released. Still in the green, but just easing back a bit. Jim, I'm going to come over to you.
Well, those remarks were kind of a muddle for me. I'm glad that the market popped, but that doesn't seem to me to be a really rational response there. There's not enough there to sink your teeth into. So to Jenny's point, well made just now, that it's going to be the passage of time and you're going to need some evolution here. I think we're back to being data dependent. Now, that's a two-way street, okay, because economic data is generally quite strong. I could point to the jobless statistics, the weekly jobless claims for today, and, that's going to provoke the Fed to go higher. But what they really need to see is inflation coming down. That's the soft landing. When's the next inflation reading? Well, it's a week from tomorrow. That's the PCE for September. That's the most watched by the Fed. We'll see what that comes in on. I think besides that data point, what you're looking for in the next week and a half before the next Fed meeting is, and I'm sorry to bring up a competing news outlet, but Nick Timiraos of the Wall Street Journal. He's the official Fed whisperer here. I think Steve does a fantastic job, taking nothing away from him. But when the Fed wants to make sure there are no surprises, it will go to Nick Timiraos. Now, right now, the markets are saying there's not going to be a Fed rate hike in November. If that changes in the Fed's mind, Nick Timiraos is going to be the one who brings it. So that's unfortunately what we've got to do for the next week and a half. I don't think the Fed is going to go in November, but there's not enough in that prepared remarks to make me think that we're all clear, not even close.
All right, guys, I'm back. Sorry about that. My dog went crazy. I'm sorry. All right. So as you see there, obviously, we have the Fed meeting today. Now I was watching this guy, of course, about Bitcoin. So let's X him out real quick. Hold on one second. Dog went crazy. Okay, so I have this up. All right, you guys. So welcome. So I have this conversation at work, and it was a refreshing conversation, obviously. Somebody who didn't know about the market and all that stuff, right? Try to kind of, I wouldn't say indoctrinate people, but just kind of speak my mind, right, on what is going on in the stock market, right? And now, I'm not claiming that I'm an expert on any of this at all. Not at all. But, I feel like investing in GameStop kind of taught me a whole bunch of stuff, right? So, and I'm sure you guys have the same experience investing in this particular company. Now, we know about GameStop, how amazing it is. And, again, I'm biased here, right? Because I have a lot of shares, right? When I say a lot, it's a lot for me. It might be peanuts to you, to whoever's watching, but it's a lot because, again, I am convicted, meaning like I have conviction in this stock. And this is a high conviction stock for me. So this is why long-term investing outlook is something that I am will be gladly to accumulate as many shares as possible. Right, but back to the education on the market in and of itself, right? Why does investing in this company make me so resilient in the stock market, right? And of course, you have to be foreseeing the future, and there's no question about it that the Fed are the driving force of the economy, right? Whatever the Fed is doing, whatever the Jerome Powell talks, the market is going to respond in a certain way, right? But as far as GameStop, I always have this theory, right, that whenever there is a panic in the street, right, and that's why I had that quote up. Hold on. Whenever there's panic in the market, which today is kind of demonstrate that, obviously, right? When Jerome Powell speaks, people freaks out, right? And for a good reason. I'm not saying it's like, a kind of unfounded freaking outness, right? Because we know that, there's so many uncertainty that is happening in the world. We have the wars going on. We have, the geopolitical landscape here. Of course, we know that the escalation of the war, Turkey is being drawn into this. My dog is back. Sorry about that. One second, you guys. Sorry. As I was saying, yes. So the world is on fire, to say the least, right? But of course, the news outlet out there, they are trying to calm the market down. And as you saw earlier, they were saying, "Oh, there's no landing," and all that stuff. Oh, this, it's like they would say stuff like this. Okay, let me show you what I mean. Right here, Jerome Powell today, right? The resilience of the economy is the story of a stronger demand. Do you actually feel right now in your personal life, when you go to the grocery, do you feel resilient? Do you feel like you have more and more than enough money to spend? Of course not. We all know this. But stuff like this is being presented to you, that the economy is resilient. When they say the economy is resilient, that's when you need to pay attention more, right? I'm a very skeptical person, because when I'm investing in, and going back to investing in GameStop here, taught me me to be skeptical of these type of news. Whether it comes off of this. Now, this guy did his own trading as well, okay? If you do the research, he sold his share, okay, right here, around here. He sold his share right around here, and that's when he, started aggressively raising rate, right? And they have not been done doing that, but at every step of the way, he keeps saying, "Oh, we're not going to do anything until the data presented itself," and and all that stuff. So he's letting the data leading his decision. And now, again, I'm not an expert on the market, obviously, but from what I've learned is that you need to get ahead from inflation by raising rate aggressively. Okay. So the only way for you to tame the inflation is as if you are raising rate above inflation rate. So go back to 2 years ago. How much inflation has been, running rampant? You've heard about 7%, 8%, 9% in some month, right? Last year. I'm not talking about this year. But what did the Fed do? Keep rate at 0. Right? Why did they do that? Because they want this to happen. Because they want this right here. Boom, 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 boom. 0 rate all through. Okay, here. So who are they trying to please? They're trying to please the billionaire out there that have massive amount of stocks, right? And of course, people who have 401k, of course, yes. I mean, that's the whole trap there, right? There are people who are about to retire, and if they sell at this price, they're going to retire with less, right? and an average American do not have that much in the saving. So yes, technically they're propping up the stock market in order to save the 401ks, you know, and regular Americans. But here's the thing. It's unsustainable. That's why we're seeing a whole bunch of inflations happening during this time. And now they're trying to do a catch-up, right? So when you do a catch-up, what do you get? You get people with less money to spend. And now when the Fed is trying to say, oh, we're not doing anything, so everything's going to go even higher, right? But eventually the bubble will burst. The question is it today? Is this right here? Is this the bubble right here? Or is this the bubble? Or it's going to go even higher and then boom, drop like crazy. Okay. I think my point of saying this to you is, why is it related to GameStop? Well, here's why. In my opinion, obviously, when the SPY's coming down, no matter what, people are going to panic like crazy, okay? When you're panicking, what happened? Hey, I don't want it anymore. I'm going to go buy bond because the bond market is paying you 5%. My dog is going crazy again. I'm sorry, you guys. You know what? Let me have you listen to Jerome Powell real quick here, and I'll come back to you, okay?
Economy, there's a lot to talk about, a lot to discuss. Let me start with something you just referred to, which is the surprise to the upside in the economic data, despite, as you termed it, I think, historically fast pace of growth. Are you surprised at how resilient the United States economy is? Just today we got jobless claims numbers, surprised because they were low. We got the retail sales numbers you mentioned. We got industrial production. Across the board, it seems like a very strong economy, despite all you've done to try to slow it down.
Yes, so we certainly have a very resilient economy on our hands. We've got the economy growing strongly. If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So that's been a surprise, driven largely by consumer spending, driven by a very strong job market with people getting jobs with first high nominal wages, and then as inflation has come down, real wages, which is spurring spending. And we've also had inflation coming down. So, you know, it really is a story of much stronger demand. There may be some ways in which the economy is less affected by interest rates. It's hard to know precisely, but for example, many companies, any company with bond market access will have termed out its debt, right? And therefore may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage, who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest-sensitive spending, these are very much the places where we expect to see and do see effects. So, for example, in housing or the housing sector has been very affected by higher rates, as purchases of durable goods. If you look at surveys, people will not say that it's a good time to buy a car or a house, quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough, and again, it's all happening in a context of very strong demand.
We've heard other people speculate maybe the terming out of debt, as you say, both corporate debt and household debt, may diminish the effectiveness of rate hikes. Do you have a view on whether that's true? And if it is true, what does it say about monetary policy? Does it mean you have to go farther in the rate hikes, or do you just not have the power to affect it?
So no, I don't think that there's a fundamental shift in the way that interest rates affect the economy. There may be some differences in this cycle because of what I mentioned. As I mentioned, we are seeing the effects where we expect to see them, which is interest-sensitive spending and also asset prices to some extent. And the exchange rate, which you're also seeing a strong exchange rate, which is disinflationary. So I don't think there's a fundamental change in the way monetary policy affects the economy. And again, it goes back to just very strong demand. We take the economy as it is. We take fiscal policy and the economy and all the things we don't control, they come to us, and we conduct policy always to achieve maximum employment and stable prices. So we just take what comes. The fact that we have a strong growing economy, a strong growing labor market, and inflation coming down, these are the elements that we want to see that to achieve the outcome we want. It may take more time, but ultimately, this is the kind of thing you would want to see along the path to getting through this without a big increase in unemployment.
How much effect thus far has the Fed had? We all have memorized now long and variable lags. How long and how variable, and where are you in that process? Are you at the 25% point, the 50% in terms of seeing it in the effect in the real economy?
So there's no precision in in our understanding of how long lags are. One thing that has changed in the modern era is that markets now, over the course of the last 30 years, central banks have decided, instead of being secretive, to be very transparent. And what that has meant is that markets move actually well in anticipation, well before our policy moves. So the transmission from policy moves to financial conditions actually happens before the moves now, whereas that was not the case 50 years ago when Milton Friedman coined the phrase long and variable lags. So, but now you have financial conditions changing, and the question is, how does it affect the economy? The standard channels are asset prices, interest-sensitive spending, and the exchange rate, for example. And we do see that happening, just not as fast as we would like. And I would attribute some of that to just stronger demand. Household savings were turned out to be higher. Household spending has been stronger, and that's by far the largest part of the economy.
All right, guys, sorry about that. It was grabbing something to eat too. Okay, so at the end there, of course, he was saying like, hey, the economy is good. That's why we're not doing anything much to it. We're gonna keep a rate at the at this price. Of course, he is gonna say that because he doesn't want to crash the stock market, right? And he doesn't want to do it too abruptly, so that the fear is going to be even exacerbating the whole sell-off thing. But eventually it's going to happen. It's going to happen either way, because next quarter, now this quarter might not be, the Armageddon, I keep saying that wrong, because they still have 2 more months to kind of post profit, right? We all know this. Institution, usually they want a good year to go off of, and then excuse me, 1 second. Sorry. So they want to post a positive quarter, right? Because they want their bonus and all that stuff. So usually, stock market end in the green. Right here at the end of the year, so it might go up again to fill this gap right here, right? And that gap, the reason why it's there, it's because, again, it's to either fake out the people that thinks, oh, the gap's gonna get filled, but then it's like, so this might be the feeling of the gap, right? And what gap am I talking about? This right here. So if you do the research, obviously, there's 80%, 80 to 85% chance that the gap would be filled. If you look at the history, you see this gap right here. It gap up and then coming back down to fill that gap. Now, this gap right here, see that? So it took quite a bit of time for the market to eventually fill that gap. If you look at that right here. So when you see those gaps, that is why 85% at the time, gaps will be filled eventually. Okay?
Blackstone reporting third quarter results earlier this morning. Revenue and profit both missed the street's expectations, though Blackstone's CEO said in the earnings release that the company is, in his words, well positioned with a record amount of dry powder, some $200 billion. Blackstone's total assets under management grew 6% in the quarter. And for more on this, we want to bring in John Gray. He's the president and chief operating officer of the Blackstone Group. And John, just looking at a few things, the distributable earnings were down by a steeper than expected 12% year over year. Steve Schwarzman said that this is what's happening. These results are coming in, and he described a pretty challenging challenging market out there. How would you describe the market that we're living in right now?
Well, good morning, Becky. And I think Steve had it right. The environment was tough in the third quarter. That's continued now with rates moving higher. That impacts markets and valuations. I think the key thing for our shareholders is our fee-related earnings are very resilient. They're pretty much flat year on year. Our management fees were up year on year for the 55th straight quarter. And the most important thing is we delivered for our customers. So across our flagship strategies, we delivered performance in excess of what we're seeing in liquid markets. We had real strength in infrastructure, in life sciences, in private credit. And to your point, with more than $200 billion of dry powder, that gives us a lot of flexibility to deploy in what looks to be a dislocated market.
Where do you see those dislocations? Where would you be deploying the dry powder?
Well, I think what's challenging is we're going to see here rates elevated because the Fed's going to stay tight for a while. I think growth will slow to the point Mike was making. You've got, 8% mortgages, 8% car loans. And so what do you think about doing? I'd point to two areas. And one of them would be being a solutions provider. So our private credit business, which has grown to be quite large, we can help companies. We can help consumers in that area. We've got businesses like Tactical Opportunities where we can provide liquidity to companies who need to deleverage. And then the second area would be you cannot rely on multiple expansion or just GDP growth. I think you have to invest in areas where there are some real long-term tailwinds. So if you think about energy transition, an area we've been quite active, digital infrastructure, what's happening in data centers driven by AI is extraordinary. It was the biggest contributor to our value increases in real estate and infrastructure in the quarter. And then I would say globally, India is a place with a lot of growth. We made a large investment in a hospital chain there. We committed in the quarter. So we look at the world and say, yes, it's a challenging place, but there are certainly opportunities.
Well, let me stop it there because I'm sorry, my dog was going crazy. But let me finish my thought real quick here. The reason why I said that, there will be panicking is because, again, there's so many uncertainty in the market right now. And the consumer, even though Jerome Powell keeps saying consumer is strong and that, is credit is like, what did he say at the end there? Hold on, let me go back.
Given everything that's going on.
Right here.
You have financial conditions changing, and the question is, how does it affect the economy? The standard channels are asset prices, interest-sensitive spending, and the exchange rate, for example. And we do see that happening, just not as fast as we would like. And I would attribute some of that to just stronger demand. Household savings were turned out to be higher. Household spending has
That's wrong, by the way.
been stronger, and that's by far the largest part of the economy.
So he's saying that, household spending is strong. Well, the reason why it's strong is because they're using credit card, right? If you research the credit card debt right here, credit card debt, credit card debt, 2020. There you go. You look at this right here. That is the reason why we're spending more. But when you spend more and then taking on debt, That is the dangerous, okay, the dangerous factor here. So if you look at right here, this is 2008, you guys. This is 2008. So we're exceeding that right now. So you're saying that this is sustainable? This is the growth of your economy? This is the strength of the economy? Because we're spending more on credit? That's not good. Eventually, somebody's going to be like, hey, I can't pay. Somebody's going to lose, right? And so how it's a matter of when, it's not a matter of if you look at that. So see this is total outstanding credit card balance 2008 to present. So this is 2008, and we know what happened at the end of 2008, right? Like plummeting. And which state's resident has the most credit card debt? Right here, the biggest economy in the nation, okay? Look at this, average credit card debt. Do you see this? $7,758 on average, rank 15. Okay. Now this one, Texas, 8,000, rank number 5. Who's the most? Well, rank number 2 is New York City. Of course, New York, right? It's expensive. Everybody is like going nuts over there. There's high life everywhere, right? Meaning, what is it? You have to keep up with the Jones, correct? New Jersey is number 3. Connecticut is number 1. Look at that. Close. I mean, $9,400 on average. And we all know what credit card does to people. Credit card is 30%, you guys. Some of them, that's the highest. That's ridiculous. Good luck trying to pay that $9,000 worth of credit card, And even in this state, the state of California, $7,000. Good luck trying to pay that off in a year. On average, we don't have that. You see what I mean? So we didn't make the top 10, but look at all of these credit cards. So that's why we have like close to $1 trillion. Or is it already $1 trillion? Yes. Look, exceeding $1 trillion just a couple months ago. That's insanity. So, at what point can people, be pushed to the brink of bankruptcy, right? And if you look at the overall national average credit card debt among cardholder with unpaid balance in December of 2022 was $7,000, $279 right here. And then we found that 25 of 50 states saw their average credit card grow by 10% or more. So what does that mean? It means that inflation is causing people to use debt in order to do the day-to-day spending, right? Because they can't make it with their own income. So that's dangerous, you guys. And the fact that the Federal Reserve chairman is saying, oh, we're resilient. You keep seeing people spending money. Well, they spend money because they have to, because they need it, and they have to use debt to do it. Okay? So how dangerous it is, I feel like it's again, I'm not here to fear-monger you or anything. I'm here to prepare you, right? So why, oh my God, every time I want to relate this to GameStop, look at what my dog is doing. All right, guys, let me continue this real quick, and sorry about my dog.
Equity giant Blackstone reporting
car loans. And so what do you think about doing? I'd point to 2 areas. And one of them would be being a solutions provider. So our private credit business, which has grown to be quite large, We can help companies. We can help consumers in that area. We've got businesses like Tactical Opportunities where we can provide liquidity to companies who need to deleverage. And then the second area would be you cannot rely on multiple expansion or just GDP growth. I think you have to invest in areas where there are some real long-term tailwinds. So if you think about energy transition, an area we've been quite active, digital infrastructure, what's happening in data centers driven by AI is extraordinary. It was the biggest contributor to our value increases in real estate and infrastructure in the quarter. And then I would say globally, India is a place with a lot of growth. We made a large investment in a hospital chain there. We committed in the quarter. So we look at the world and say, yes, it's a challenging place, but there are certainly opportunities.
What is the situation with commercial real estate? That's been a huge issue. That's been something you guys have been concerned about, and lots of others too. But commercial real estate, are we nearing an end to the woes there, or with rates still so high, is that going to continue to be a problem for quite a while, unless and until the Fed brings down rates?
Well, I'd say there are two notable headwinds. Obviously, office buildings, which you've talked a lot about on your program, face some secular challenges given remote work and some obsolescence issues. For us, fortunately, that's a very small piece of what we do in the U.S. The second challenge, of course, is the rise in cost of capital, which does have an implication in the near term for all commercial real estate. I think two things to keep in mind, though. One is if you invest in sectors with higher growth, we have a majority of our capital in logistics, in student housing, in data centers. There you're better positioned to absorb this higher cost of capital. And the second thing is we're seeing a sharp decline in new construction, down 30 to 70% in this last quarter in most areas of commercial real estate. And that lays the framework, the groundwork for a future recovery in value. So yes, the near-term picture more challenging. We like to be long-term investors.
Hey, John, I've always been curious about this. If I go out and buy a home right now, I have to get a mortgage for 8%. You guys buy homes. What is your cost of funds in that space?
Well, the cost of borrowing is not much different, Steve, for commercial investors in real estate and residential investors. You don't have the flexibility to prepay those 30-year mortgages, which Fannie Mae and Freddie Mac allow individual homeowners to have. So there's an advantage. But the cost of capital has moved up, and so that does make the economics in sectors tougher. We do have a structural shortage in housing, and it's one of the areas that's going to get exacerbated by this high cost of capital, which we think will persist for some time.
So does it make sense for you guys to still hold on to that housing inventory, or should you be selling some of that housing inventory?
Well, I think it depends, but I think if you take an intermediate, longer-term view, we've been underbuilding housing by about 4 or 5 million homes since the financial crisis. We're now going to see housing starts, I believe, across multifamily and single family probably come down, exacerbating that shortage. And so if you think about an asset class over time, I think it should have pretty good performance, even if there are some near-term challenges.
John, we've been talking about higher yields from the cost of capital perspective, but, you know, somebody owns the assets, you among them, and so therefore you're earning more off of plain vanilla public fixed income assets, treasuries and corporate bonds. Does that raise the hurdle rate for returns for somebody considering, you know, investing in alternatives? I mean, you've been able to gather all these assets at a time when returns were scarcer.
Well, I would say this. Obviously, when the risk-free rate goes up, you do have to generate higher returns. The good news for us is a couple things. One is we have done that for a long period of time in lower rate environments and in higher rate environments. So if you can buy a business or an asset, improve management, invest capital wisely, drive returns higher, that works in any environment. The other thing I would say is we've got a very large credit business between corporate and real estate credit, nearly $400 billion. Most of that is floating rate, and it's benefiting from this higher rate environment. So you are seeing clients lean in that direction. More than half the capital we raised in the quarter was in the private or the credit space overall.
You just said, would you want to own equities? I mean, there's also the question of what you think is going on in the United States with our economy, with the rest of the world, with what the Federal Reserve is or isn't going to do.
It's a really challenging time to want to be an equity investor in U.S. stocks right now. It's really hard because, again, you've got the geopolitical uncertainty, which I think, come to live with to a certain extent. But again, all those have the ability to have a nonlinear outcome. So something not just business as usual. But I think equally as much of a problem is the fiscal situation that we're facing in the United States, which is going to require a completely different political mentality to what got us here.
That's pretty telling. So we're, the possibility of a real possibility of a nuclear war is there, but our fiscal situation is just as bad. That's a statement. So black swans.
All right, guys, I'm sorry about that. My dog went crazy. I should have kind of prepared ahead of time. Sorry about that. So what I was saying, I bet, hold on, let me see how many video already that you guys have been watching. I'm sorry about that again. So what I was trying to say is that when they are panicking, right here, so again, you've listened to those people that I play for you right here. Of course, like this is Tudor Jones. He's been right apparently most part for all of the economic, and of course, like if you listen to this one was 9 days ago. It was talking about how the war is one thing, that's one catalyst that could be black swan events that is going to cascade, right? But the fiscal policy that we have as a country needs to be revamped, right? And to me, it's the military spending, right? But here's the thing. Somebody's going to benefit from that. When there's chaos in the world, somebody's going to benefit from it, hands down, right? And so I'd rather, people be more aware of that black swan event, that it could happen. That when SPY is selling off, just know that GME is going to go down with it as well. Now, I'm talking about the stock price here. I'm not talking about the company. You have to separate between the company, what the company is doing, and the stock price. These are two different things, okay? And this is where the emotions comes in, right? You take your emotion out and evaluate the company based on the balance sheets, right? But I'm just saying to you that there's panicking. And people are starting to fear all those economic data that I just showed you. The credit card debt, the fact that we have uncertain in the war. Again, it comes again, this dog. Sorry. But anyway, so when there's sell-off, just be prepared for that, right? And this is where the true testament of who wants to hold this company to the nth degree, right? And today it looks like they are going to bring it down. And again, if you watch Moran's video a couple hours ago, he came out with a video saying that nobody is selling, right? Now the volume pick up a little bit, I'm not gonna lie, right here. But if you look at the right here, see up here, right now, if you look at it, it's 5.8 million shares being traded back and forth. Now 5.8 is less than 2%, okay, of the shares being traded back and forth. Yes, there's more than let's see, yesterday it was 4 million shares, sorry. And then the day before was 3.8 million shares. So today was a lot more panicky than yesterday, but it's still, keep in mind, I'm saying to you that this is only less than 2% of the company is being traded today, yesterday, and every single day. It's like a very low, very low. And anytime there's buying, if you look at right here, when they sell, 18 million shares sold this day right here, before Ryan Cohen got in. Then when Ryan Cohen buys right here, back in June, it's right here, June 9th, the volume picked back up again. And if you look at the volume, see, $17 million up there, $19 million, 19 million shares right there. And then you have 17 million shares. So the buys is always exceeding the sell. Look at the sell. 7 million, 5 million, 4 million. You see what I mean? So again, the volume has been diminishing ever since. So what am I trying to tell you? I'm trying to tell you, when there's panicking in the street, you're going to see the cascading right here. Some people are going to sell, right? Some people are going to be like, oh my God, it's going to be zero. It's going to go to zero. Keep in mind, the only way that your investment in GameStop going to zero, if the company itself file for bankruptcy. Okay? So the price really doesn't matter. This is psychological warfare, you guys, meaning that they're fighting you, so you will sell out of this company at the worst time possible. It could be the crash, right? Again, if the S&P 500 dropped from here to down here, you better believe that GameStop could hit $9, $10, even down here when Ryan Cohen bought in the original time, right? Anything's possible. And so when that happened, I want you to remember this. Baron Rothschild, okay? And why did I bring him up? Well, he's the one that famously said, the time to buy is when there's blood in the street. And I think there's another edit saying that even if that blood is your own blood. So, I mean, it's fitting, right? Like, I've been buying since up here, $40, you guys. Right here, around here. That's when I bought it. Like, $40, right here. That's my cost average. And again, this is my long-term portfolio, okay? I have a long-term, mid-term, and even longer term. So, no, my longer term is like 401k, like the index fund and all that stuff, right? So that's, I have it through my employer, through my full-time job. But I have my own portfolio as well. That's where I pick GameStop to be my, long-term backholder for my own control. So that way I could pick my own stock, I could pick my own investment vehicle in order to get me to that retirement place, right? That's just my own strategy here. So I'm not worried seeing GameStop at this price. Obviously, I want to add more. Right now, I'm saving as much as I can in order to buy when there's blood in the street type of scenario. And so again, that's why I'm trying to prepare all of you that you could see GameStop at $10. And it might be baffling to you because again, you know what this company is all about. And that's why you always fall back to this sheet right here. Always. You know why? Because you see stuff like this. You see, okay, let's go through it again, just in case people forget. Price to sell lower than 1, meaning that's a good thing, valuation wise. Let's see, book value 3 times the, what is it? Hold on. Shareholder equity. 3 times. It used to be 4. Now it's 3. So it's better. meaning that you have more shareholder equity than the capitalization of the market. That's insanity. Look at this. Since the price went down, it's even better at a better, cash flow positive type thing. Free cash flow, sorry. Versus capitalization. It used to be 17, now 15. So it's become more and more attractive to people. If you look at the operating income, obviously it was still down, this is 12 months. Look at this, 12 months base, trailing 12 months. So we still have 2 more quarters of this fiscal year. So it's a matter of you believing that GameStop could out-earn this particular here to wipe it clean. Whether it's this quarter or the next quarter, it's remained to be seen. They could wipe out at least half of that, right? If that's the case for this quarter, then technically the fourth quarter is when, the profit posts as much as they can, right? Because the fourth quarter is where the money is being made for this company anyway, the majority of it. And then this is comforting to me to see, right, that they have $1 billion in cash, right, including the marketable security, which is $300 million, which is here to accumulate the interest, right? They make interest on $300 million worth of cash. And on top of that, total debt, this is like short-term debt, right? Current debt, look at this, current debt plus long-term debt. That's total debt. Okay, so both of them is only close to $500 million right there. And then if you do cash minus total debt, they still have $500 million to work with, right? To do whatever it does or it needs to do before going to shareholder for that type of money to operate the company, to keep the companies going, meaning that they're not going to be diluting the shares in order to make more money. To do that, they have more than enough money, correct, to do a correct business model. Okay, and then this is also comforting. Look at this, working capital. So if you look at the definition, working capital is the amount of money available to do business or to conduct day-to-day operation. So they have more than enough money to do that right now. And on top of that, if they want to load on debt, guess what? They have a revolving credit of $500 million at a very low price, at a very low rate. They call it a revolving credit. So they have that ability as well. But right now, they're not going to do that. Why? Because they have enough money to do that. Okay, to do whatever they need to do without going to shareholder. Just know that. Operating cash flow, look, $300 million in the positive. So what is there to be scared of? Nothing. Every metric that you look at, GameStop is better. It's not perfect, but it's better than it used to be, right? But yet, the price keep pummeling down. Why? Well, there's bad news, right? If you haven't noticed already, they have some employer. Now, it's not on this headline, oddly. I have no love for GME, but it's unusually active option are worth taking a look. Okay, so option chain. So I haven't read this yet, so I'll go through that later. But so apparently option, unusually option. So let's see, $10 strike price bid for this, 3 cents higher than usual, the bottom line. So April, $10 strike price have a bid of $1. So that's $100 per share. I mean, sorry, that's $100 per contract. Strike price of that is 14 cents higher. It makes sense given that the share is down 3%. Anyway, even though I'm not a fan, you can make money on these. But be prepared to pay $1,000 to $1,200 to buy the share. Should they be put to you? Apparently there was like a high put buying option chain, but that's too complex for me to even try to explain to you. I don't even understand it myself, honestly. You know, I kind of dabble in option on my own time, but of course, like, you know, selling option is very risky because you could lose your share, you know. And if you want to gamble on that, that's on you. You know, I have some option as well, but I only work with my immediate trading account. I have my long-term holding, remember, too. So it's just me trying to learn as much as I can about the, you know, puts or whatever, what give you, what have you, sorry. So yeah, puts and calls and stuff like that. Again, I'm not too much qualified to kind of talk about this yet, but apparently there was an unusually kind of high in volume when it comes to buying puts. So that's why the stock went down as well. So it's not just the negative news that we saw. Remember, there was apparently there was a employee who the employee shot somebody who was shopping at Gamestop because of theft or something like that. That was yesterday, and now it's up again, right? So, man, I'm sorry. This is a long-winded discussion. Due to my dog, I'm sorry about that, but I hope you get something out of this particular live stream. I just wanted to kind of preface to you that, you know, hey, this price is amazing, but, you know, knowing the macro economy that is about to kind of, this drop is steep, you guys. Now, I'm not saying it's going to go to this particular one, but if it's going to take down this low, it's going to cause some havoc on the market. People are going to panic and sell even lower. So that panic, we already seen here. Look at this. From here to here. That was COVID, you guys. That was COVID. 30% drop. Okay, and you see Bitcoin went down, you know, to $3,000 a coin. So 34% would be right around there, right around this support level, right? I mean, that's a possibility right there. It's gonna send chill down some people's spines here. So this is around 40% drop. This is around 20% drop if it goes to the previous high of the coronavirus, right? We know all that. So again, the possibility is endless. And when it drops, look at the drop. It's very quick. It's very quick. So just be prepared for that. Just be prepared to see GameStop at $10, you know, at $10 right here, or even down here. This is when Ryan Cohen got in. So this is the price range that Ryan Cohen got in. So will you hold your share or buy more? That's on you to decide. Now you might be tempted to sell it here. Okay, if that's your prerogative, you could do that as well. If that's you want to gamble, okay? So I'm not going to tell you to buy, sell, hold, or whatever, but keep in mind, there's a famous saying here. buy when there's blood in the streets. Okay. So, all right, you guys, I'm gonna sign out right now. Again, sorry about the long-windedness, but if you want to continue to watch this, I'll post the link down in the comments, and so you could continue to watch this one. All right, I will see you in the later video.